All right, you guys, I'm recording this, and I mentioned at the beginning of every single webinar is watch this again. Some of the nuances might go by you the first time, the second time through, you'll remember it. And, if you watch it again, even if you've gotten it down pat the first time, well, if you watch it again, it will sink into your long-term memory. Believe it or not, you might think you have it, and then a month or two down the road, you might be thinking, wait, what was that he said about implied volatility or something like that? All right, so try and watch it again. Make sure it sinks into your long-term memory. But let me get a couple of things out of the way real quick for some of you who are new. My name's Eric Wilkinson, and you may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. I actually started trading in college with some money I had earned and trying to get a psychology degree. Decided to switch it over to finance. After graduating from finance, I literally packed my bags, moved to Chicago, and walked onto the floor of the Board of Trade and have been trading my own money ever since. So I've traded everything from stocks, financial futures, commodity futures, and options on all these products and just about all the market conditions you've probably come across. I have to go over this, you guys, because we are an educational company. So any opinions, news, research, or analysis or other information provided in this webinar by myself or other employees is general commentary and does not constitute investment advice or solicitation to buy or sell any of these types of securities, blah, blah, blah. And the reason why is because I don't know what's in your portfolio. I don't know what your risk parameters are. Therefore, I cannot possibly give you investment advice, all right? What we're trying to do here is to teach you guys how to think for yourself, or I like to say, we're trying to teach you how to swim. We're not trying to swim for you. Bottom line is also past performance of any trading system or methodology is not necessarily indicative of future results. And the other thing is I might be talking about some of my own stuff. I might be talking about some stocks that are already in my portfolio. I am not trying to get you guys to living off the cliff with me. I want you guys just to see how, I go through a process and stay mechanical, and therefore I use those as examples, all right? You can follow us on Twitter at Wolfman's blog. That's me, or our parent company at ProTraderStrat. And I forgot we got our Facebook page, and that is at ProTrader Strategies, and you can just look that up in the search window since I don't have it up there, but it's just ProTrader Strategies or at ProTraderStrategies.com, something like that. But Facebook, the reason why I mention it is because I put out a lot of content on there, so it's pretty accessible. Daily market commentaries where I talk about everything I do. I talk about the economic data, how I think it's going to impact the markets and all of that stuff. Some of that gets thrown out there. Not all of it, but some of it does. All right, short call spreads. And we're talking about implementing these into our portfolio. One thing is I've done a lot of different short call spread videos, all right? And that's usually on a trade for a directional assumption. What we're doing in this video is to try and talk about how we implement a short call spread around something we already have in our portfolio, okay? So say, for instance, we are long eBay or something like that, eBay, IBM, whatever. We're going to try to lower our cost basis by using call spreads on something like in this type of environment we're currently in. There is always something that is looking at a correction or maybe bad news coming out with the next flu virus or something like that we've had. Well, that could cause a slowdown in the economy, especially something as big as the coronavirus, right? So something along those lines could cause negative impact on the market. We need to make sure that we are staying mechanical with our portfolios. A lot of you guys even have 401ks. Not that you could implement this into a 401k, but you guys should be keeping an eye on what's in your 401k. And therefore, when you go over to your trading platform, you can actually hedge that stuff. It's not a direct hedge. If you do a short call against something that's in your portfolio, no, it's not going to get called away from you necessarily, but it will still act the same. Is really what I'm getting at. So we can always take advantage of that in a portfolio, even though you take all of your different assets and think of them as a whole. There's the one I forgot to have up there. It's the Facebook page if you didn't get to see that before. All right. So I see a couple questions coming up. All right. Tom's in. Covered call to make the long spread. Covered call to make the long spread. I'm not really quite sure what you're saying about this. This is basically like a covered call, but you know what we would look at this as is maybe it's something like we're nervous about this correction. You know, let's just take for instance, I'm long Delta Airlines in my portfolio. I'm worried about global travel. That's going to impact their overall earnings and stuff like that. Maybe the bad sentiment could cause this market to come down a little bit. Same thing with, like, let's say with the gambling houses, Wynn or Las Vegas Sands. You know, those guys are very entrenched in Macau, and that could really be impacted right now. So their overall earnings could be impacted, or there's just going to be some negative sentiment around that. That would be a good time to start adding in a short call spread. I generally speaking, if I'm going to try and stay mechanical and lower cost basis, you know, and I'm still a little bit worried about the upside, I would probably be doing just the short call against my underlying in my portfolio. Not a complete hedge. You know, if you're long 500 shares, I would do covered calls about half that, you know, maybe 2 or 3 contracts in the options. Same goes for the short call spread. If I have, you know, 500, or even if I have 200 long, let's say Las Vegas Sands, I would probably only do a 1-lot short call spread. I'd probably hedge about half of that. And we're just overall trying to lower our cost basis of what we paid for that underlying and take advantage of a correction. Great other example for using this, a short call spread, is that we're still worried about the upside, or we don't want to take capital gains on this underlying, but we want to try and lower our basis. Well, you know, if it blows through our short call spread, then, you know, we're just going to cover that spread for the max loss and move on with our lives. We get to keep that stock. We don't have to take the capital gains and all of that stuff. This would be a credit spread. Yes, absolutely. Yes, John, it would be a credit spread. Hi, Alexander. Good to see you back again. All right, so yes, we are going to be collecting a credit, and I'm going to be talking about the specifics of how much of a credit we would want to take in this particular situation. All right, our max profit, we're going to be collecting a credit, as John mentioned there. That credit is our max profit. The premium we receive is our max profit. We will have a max loss. That's going to be the long call strike minus the short call strike minus that premium received. So let's say, for instance, we're doing the March and we get short the 100 calls and we're long the 105 calls, right? And we collect a credit, and our credit is, let's say it's on a $5 wide. I'm just going to say my minimum credit received is going to be $1.25. That's one of my rules. I'm getting ahead of myself there. So basically it is $5 minus that $1.25 is going to equal $3.75 would be our max loss. All right. So that would be where our max loss is. Max profit is that $1.25. All right. In that particular case, that's not always going to be the case, but in that example of XYZ, that would be the case. All right. Our break even point is going to be the short call plus that premium received. So in that last example, I said our March, we were getting short the 100 calls, right? And we got a credit and our credit was $1.25. Well, where's our break even? Our break even is going to be then 101.25. All right. So anything above that, we're going to be starting to lose a little bit of money on this trade. All right. But remember, if it never gets up to that 100 call, we get that $1.25 credit. Well, that lowers what we paid for that underlying by $1.25. Now, remember, I said if you're long 200 stock, we're long XYZ. XYZ, we have 200 shares, right? Shares. All right, we have 200 shares, and I'm saying do a one lot. Well, one lot in options, sell one option spread, call spread. All right, we're going to sell one option call spread. Well, we're only hedging 100 of that. So you could also say, well, all right, you know, I've gotten a credit of $1.25. Well, you're lowering your basis on each of those by 75 cents. And actually not quite 75 cents. That's about 63 cents or something. All right. So you're lowering your basis by about half of that. If you're doing half of what the underlying you own in the underlying, a third, if you had 1,000 shares and you only wanted to do 3 options, right? Then you're hedging 300 of those. So you'd have to think about dispersing that credit over all of them if you were the winner on that. All right. Anybody else lose sound? It looks like on my end, my audio is showing through. So if you guys could hit me up, otherwise you would have to try and log out and back in. Let's see. Everybody else got sound still? You can hit me up in the questions box. That's how we're going to kind of communicate back and forth. All right. We're starting to see people, so I'm trying to tell. All right, good enough. We'll keep moving along. I sent Norm a personal note to, if you guys ever lose sound, one of the things to do is log out, log back in. Sometimes GoTo will have a problem with your streaming, and that's probably the best way to do it. All right, cool. All right, so we've got that. We've gotten our basis on this. Now, one of the things is not every stock is created equal. So I like to say, you know, you need to pick the right underlying for this, because you might have stocks in your portfolio that don't fit this rule necessarily. And we need to make sure that we aren't getting, especially as newer traders, making sure that we're not getting into an underlying that we are not, let me delete that, not getting involved in that doesn't fit these rules, because I don't want you guys giving up too much edge to somebody. I don't want somebody else to make money on your back. So I've come up with some simple rules for this. And basically, any stock that's under $100, what we're going to be looking at is taking, well, stock under $100 is really easy. So if XYZ is less than $100, all right, then basically we need the bid to the offer to be less than 10 cents wide, less than 10 cents wide in the spot month, All right. Now, of course, I don't have that up here right now because I'm trying to, the spot month, it's kind of a pick 'em right now. You know, usually it's closest to 35 days to expiration, but I would have to say that the February contract is probably still being a little bit more traded than the 50 days out here. So I would probably use this February as trying to fit this rule. You can see that Delta Airlines fits that rule way out here, even after the close when everybody's orders are being canceled. So this rule is really for during open market operations. So look at the calls and the puts. Make sure that if it's a less than $100 stock, it fits that rule of being less than 10 cents wide in the spot month. So you could look at all of these and see even at 50 days out, it fits that rule. And then if you're looking at something that is over $100 stock, let me just try and roll this to where we'd be. It's not going to probably work out if I find something else. Let's look at a stock that's over $100. And I don't know if Cummings is going to fit that rule, but we'll take a look at it. Over $100 stock, 1, 2, 3 ticks to the left. We need it to be about 16 cents wide. You can see Cummings, this is after the hours. It is not, I don't even know why I have Feb up, is not fitting that rule right now. A lot of times it will, but it's not fitting the rule right now. So let's take a look at Caterpillar. Caterpillar's over $100 stock, so 3 ticks to the left, 13 cents wide, right? If I just go 3 ticks to the left, 1, 2, 3, it's basically 13.5 cents. So we look back down here, make sure it fits that rule. It's pretty off right now after the market closes, but you can see some of those are fitting that rule, some of them are not. Let's say, but make sure you just look at that during open market operations to fit that rule. Any stock that's over $100, you're going to move that decimal 3 ticks to the left and try and fit that in there. All right. So still the same rule for that as I would do if you were just using, if you had a bearish assumption, that rule still fits the same. You know, you don't have Caterpillar in your portfolio, you would still follow that same rule. If you had a short bias in Caterpillar, thinking there was a global slowdown and Caterpillar was going to be hurt or something along those lines, that rule would still fit for the short call spread outright, or even as a hedge on your underlying. All right. So picking the right strikes. We're going to start out with something where we are looking for about a 36-ish delta. And this still goes to the same. You guys will get the gist. I'm usually looking at it around that 36-ish delta for a lot of different ones, or the 16 delta in the short call, right? On just the short call, not the short, this is on the short call spread. We're looking at starting at the 36 delta short call. We were looking at the 16 delta, right? Well, we're going to be looking at this, and that's, you know, basically giving us about a, you know, 66% probability of success or 64% probability of success with this trade, which is pretty good, right? I mean, your risk is definitely less than the possibility of being wrong. And the reason why we look at that 36 delta is we're kind of going out to about the half a standard deviation right here. So if you add up all of these whoops, we're going to be looking at the calls. Oops, let's go to this. Always look at the left side as the calls, and it's really not. As you can see here, so that would be on the put side, because you can see down here they're negative. We want to look at the call side, which is to the upside. So right here is on the call side, right? And if you basically add up all of these probabilities going out from here to here, you'll see that 15 plus 9, 4, and all of that is basically going to add up very close to probably 34. So a 34 delta will work as well. I usually kind of start with the 36 delta, and then if I can move out that way. Now, if there is if there's a lot more volatility, you might even be able to get out to the 30 delta, right? So keep that in mind. The higher volatility will allow this to get further away as well. Did you mean the 36 delta and the 16 delta for the short side? It's going to be about a 30. John, you're all over this. If we use that 36 delta, we're going to probably get short the 36 delta, and it's going to be about a 20-ish delta that we get long, is what this is going to amount to at the end of the day. But I am more concerned, rather than, you know, this one that we're getting long, I'm more concerned about our credit. That's the star, all right? We want to make sure we get the correct amount of credit for this in order to move along. But starting out with that 36 delta, more importantly though, I want to get a collection. I want to collect somewhere between 25 and 30% of the spread of this, or of the, sorry, I got a little bit close there, of the spread, right? So that's when I was talking about, remember we said we're going to be looking at that March 100, 105 call spread. So we'd be getting short here, and we're getting long those. Well, it's a $5 wide. My minimum credit of $1.25, that would be the minimum. All right. And then basically on the upside, I'm going to be looking at something like, you know, somewhere in the $1.50 is really the sweet spot for this. Somewhere about $1.50-ish is, you know, the star is what I want. You know, this is the one I want. That would be the best case scenario. You know, $1.50, actually $1.60 would be the best because that's really about a third. Do you do weekly spreads? Yes, I would do weekly spreads. I don't often do the weeklies. I usually look at the monthlies. The reason why is because there's a lot more eyeballs in there, and I feel like there's better pricing usually. But if you are going to do weeklies and try and nail down the theta component, where it's, you know, right after 35 days, you start really seeing theta start to pick up. I have no problem using those weeklies that are, you know, in the best case scenario for theta contraction. Just make sure it fits that one rule. You know, when we talked about fitting the right underlying, that you move the decimal and the bid offer is still within that parameter. All right, because sometimes, even though, you know, most stocks, if they don't have a lot of volume and open interest, they don't have weeklies. And usually when they start getting a lot of volume and open interest, then they start opening up weeklies for those underlyings. But just make sure that it still fits that rule, because that rule, not only, the reason why I talk about that rule is so you don't have to go and try and figure out if there's a lot of open interest in there. Yeah, you can click on the tab to see if there's a lot of volume and open interest, but that's not always the end all be all. You know, you might have days where there's not a lot of volume going on in that underlying, but there's really tight bid asks. And that's because people are rolling out in time and stuff like that. And maybe the volume hasn't really picked up in there, but there's a lot of eyeballs in there watching it. That makes sense, Elias? Shouldn't the premium when we buy the spread back be less than $1.25? Yes, absolutely. You know, when you buy it back, now here's the difference. When I talk about doing just a short call spread for a directional assumption, let's say a correction or something like that, I'm usually looking to take a credit of, or a collection of about 50% of it. So, you know, when the $1.25 went down to 75 cents on just a directional move for a trade, I'm probably going to cover that for about 50% of max profit. With this one, I'm usually going to let these ride out a little bit longer, all right? Because my thought process here is I'm trying to lower my overall cost basis on this. Now, obviously, if your assumption changes all of a sudden, cover that immediately. And I would say that goes for any trade you ever put on. If you ever get that gut feeling that, you know what, I'm not really loving this right now, I'm kind of worried about, dude, cover it, all right? You guys, I can't emphasize that enough. If your assumption ever wanes, cover it, all right? Because there's something in there in your gut that's telling you, it's your limbic brain that cannot convey a voice. It can't tell you, it can't speak to you. It can only give you that feeling, and it can process so much information that you can't really comprehend. You know, that's my psychology degree coming into this whole trading aspect. And, you know, I've always said, you know, I think my psychology degree has benefited my trading more than probably my financial degree. And that's part of it. Is like, you know, I can't emphasize it enough. If your gut ever kind of tells you, hey, I probably should get out of this, and you don't, you're going to watch it go wrong. It's going to go against you because your limbic is probably right. And you're trying to come up with a reason to stay in it. I would say that that's the time to get out. I'm trying. Yes. Are you saying that we should get a premium of $1.60 or $1.25? The sweet spot, I would shoot for $1.50. The minimum I'm willing to take is $1.25 on a $5 wide spread. All right. But remember, the real rule there is 25% to about 30% of the spread is what we're looking at. You know, you can do spreads where you're going to get about 50% of that spread, right? But you're also going to be selling like a 48 delta or something, which is really close to the market there. All right. Somebody else is saying they lost sound. Can you guys hit me up again to make sure we still have sound? All right, the right duration. I kind of mentioned this with previously. Somebody was asking about the weeklies. You know, we're going to look at 35 days to expiration. That's the sweet spot there. Why? Because that's when we're going to see theta fall off a cliff. And as a matter of fact, here we go with this one. Theta contraction. These are the at the monies. We are going to be doing slightly out of the monies, and I don't want to argue whether or not this graph is represented or a good representation. You know, so basically, these are basically looking at a 50 delta, and yes, we are looking at a 36 delta, and this graph could be slightly different. What I want you guys to see here is 35 days to expiration. You can see theta, that thief in the night that comes and steals our premium in our options, really starts to accelerate. Well, that's good. Anytime you're collecting a credit, right? If I sell for a credit or I collect a credit and I buy back for, you know, which is going to be a debit, right? If I buy it back for a debit, well, obviously I want to sell high and buy low. So we want to sell it when there's still some good premium in there. You know, right now we're kind of in here and you can see that those premiums have really started decaying. Yes, it starts accelerating a little bit more, but you really need to get it out to about that 35 days to expiration. And because we're falling right in between there and about that 50 days out here, you know, I'm probably going to be looking at those 50 days out for the best trade at this point, because I want to collect that credit and I want to get a little further away from where the underlying's trading. You know, if you're going in at those 22 days to expiration, it's going to be pretty close to where the underlying is. Probabilities are still the probabilities, but for me, I like to default a little bit further out than a little bit further in. 50 days to entry, 30 days to exit. No, I'm just saying the sweet spot, the best case scenarios to hit it on days to expiration is right here. This is, you know, the first one. You know, if you can get as close to that, you know, whether it's here or say here, you know, but I'm usually going to default slightly further out, right? And right now, I think we're trading right around 22 days to expiration, so it falls in right here. Well, in that case, the question is, do I want this one or do I want those 50 days to expiration? And you're going to have to make that decision, right? I personally like to go further out in time rather than necessarily further in, because to me, it feels like you can get a little bit further away. I can get better. I feel like I can get better strike location, especially if you're looking at Fibonacci's and stuff like that. It feels like usually you can get a little, if you go a little bit further out, you might be able to get over like a resistance area. So I usually just default. All I'm saying is if you have 35 days to expiration, that's probably one of the best. You want to nail it as close to 35 days to expiration. Right now, we're kind of in that zone where, you know, 20 some days to expiration, you know, it's kind of a pick 'em. You know, they're almost as far away from 35 days to expiration as you get. So where do you go? Well, in that case, if it's a pick 'em, I'm usually going to default further out. Now, the exit, I'm probably going to ride this out a little bit further if I'm using this as a short covered call strategy, right? This is for a covered call. I'm going to ride it out and try and get about as much premium out of it as I can. You know, I might cover it, say I cover it for maybe a nickel or something like that. Or, you know, if I sold it for $1.25, if I get out for 25, sold it for $1.25 and get out for 25 cents, I've collected a full dollar. Yes, I'll probably do that because I don't want that risk of this thing switching around on me and I start worrying about losing money on it, right? So we're just trying to, you're trying to take little jabs at this, or you're trying to swing for singles, right? If you get the directionality right away, and in like 5 days, you're at 50% of max profit on this, like it's gone from $1.25 and it's trading 60 in like 5 days, I'd probably cover it, right? Because it was an easy win. Take it and move on. Maybe even go out and go out further in duration and get up further and away from where the underlying is trading, right? And continuously try to do that. But if you get it right, then yes, Amaro, do you consider skew in the analysis? I actually had a bunch of skew analysis ones on this, but that's usually more associated with a short call spread if I'm just doing that for a directional assumption. With this, my mindset is I want to stay mechanical with this underlying. I want to lower cost basis on it. So I'm not going to really be considering implied volatility, which is why I put implied volatility, one of the last slides here, and the environment. This is what I usually talk about, IV percent. Now, if it's just a trade, if we are just looking at implementing options for a trade, I have a bearish directional assumption, but I don't have the underlying, then this is absolutely a consideration. We need to have it be greater than an IV percent of 50, all right? But right now, if I'm just trying to lower my cost basis on this trade, or I have a slightly bearish assumption in the short term for an underlying I have in a portfolio, or I, like I said, want to cover my cost basis, and if it continues to rally, I don't want to take capital gains on it, and I have that long put to offset my short call, then IV percent is not going to be that much of a consideration. Now, having said that, if implied volatility is absolutely dirt cheap, right, and it's at less than 30 IV percent, it's not going to fit the strike rule of being able to collect a credit. We want to try and get at to that 36 delta. If implied volatility is super low, you are going to be basically selling the at the money to try and get 25%, 25 to 30% the width. All right. So make sure that it's still going to follow that rule. If we are just doing this as a short trade for a directional assumption, then you want an IV percent of above 50. And because you're asking if you guys are considering this, IV percent is figured out by current implied volatility minus the low implied volatility, right? And you take that sum and you divide it by the high implied volatility minus the low implied volatility, all right? All right, so that's how you figure out implied volatility percent. You do that, you come up with the implied volatilities and do that math, it'll come up. The other thing you could really do is pull up, you can pull up a chart or something like that. Let's just say for like eBay or whatever. Of course, this is on a short chart. Let's throw it up to a day. You can see implied volatility. I have it as a chart. Well, it doesn't say anywhere on here. Maybe my platform doesn't tell me. I can see that that's really low. I can also tell you that doing a short call spread here would probably be very close to where the underlying is trading. And in that case, I might just hold off, right? Or I would really consider doing the short calls to cover some of the, to get further away and get a nice collection of probably like 30 cents for something like eBay. Be selling like a 16 delta to get 25, 30 cents out of it. Right. So the skew is really going to be determined. And if you guys are wondering about skew, it's basically not all bell curves are created equal. I've showed you the one bell curve that looks like that, right? Well, if you have let's say call skew or put skew, the curve kind of goes like that, right? You have a long tail in a sense where it'll jack up and go out like that, right? You know, in that one graph, this would be call skew and this would be the put skew. Basically means the puts have more premium than the calls. It also is a tendency to have bias to the call side here, where people are buying more calls than buying puts, where it's more of a bullish sentiment. But me being a contrarian, I would obviously look for this for the call spread. I would be like, check it off. There's call premium in there. I always say, you know, volatility is overstated. I would say most times, more times than not, volatility is overstated. It's a fear thing. It's a I'm missing out or I don't want to get hurt kind of thing. And it's usually overstated. And that is the time to take advantage of it, in my experience. All right. So environment, you know, for this one, I'm going to say environment really doesn't work if it is for the covered call, covered short call spread, right? We're covering a long underlying, right? And when we're doing the right underlying, we know that thing. But I also want to talk about here is size. All right, remember, sizing, I would do half of what you own in XYZ, right? So, you know, if you have XYZ, you know, you have 1,000 shares, we're going to do a 5 lot. If you have 200 shares, you're going to do a 1 lot. If you have 100 shares, then I would do a 1 lot and just lower my cost basis on this. All right, but if you're doing it as just a trade on a directional assumption, you need to go for an implied volatility percent of greater than 50. And it's going to help with this strategy also. If you have the underlying and you have a higher implied volatility, then that's the time to do it. One thing to note is I would avoid earnings for that underlying, right? If you've got this in your portfolio, you're obviously long-term bullish, all right? And if you are long-term bullish, one of those times to be bullish is for those earnings, right? I mean, if you are worried about those earnings, then, I would say, that would be okay to do if you thought, the virus or Boeing's woes or something like that could really impact what's going to happen. Let's say we already saw Las Vegas Sands and Wynn has earnings coming up. Well, you saw what their earnings were and not doing so great. You can assume that maybe Wynn isn't going to do that well also. So then, you could put a short call spread on that for that earnings cycle. But we know it's because we have a bearish assumption in there, a short-term bearish assumption. We don't, and if Wynn beats on the street and blows through our call spread, well, we don't have to take capital gains. We don't lose that stock. We just cover the trade for the max loss on it. We lost a little bit of the upside, and we still get to keep the stock. We just move on with our lives and continue to stay mechanical. You are going to lose on some of these, you guys. But over time, over the long duration, you are going to be a net winner. It's the probabilities, right? I talked about this. This has a 66% probability or 65% probability chance of a win, okay? I mean, the probabilities are probabilities. They work themselves out. All right, so without further ado, I see a couple questions coming up. Let me pull up the platform. I'm sorry. I hope I'm not getting coronavirus. Find it hard to believe I would, unless you can get it over the phone. I haven't been out of the house in decades because I work from home. I'm a trader, squirreled away in an office. All right. Why not cover all of the equity with the covered call to reduce the net cost basis of the equity? Bob, that's a great question. If you are a little bit more aggressive, higher risk tolerance, then absolutely. If you aren't worried about, losing the stock or any of that stuff, not that you would lose the stock with this one, then absolutely. I'm just saying most people probably have a little bit less risk tolerance or maybe newer to trading options. I don't want to see them go through that angst right away. Yes, the higher your risk tolerance is, or the more aggressive you are, that's just a little bit more aggressive. Bob, I would cover all of them. If I had 1,000 of the underlying, I would be doing a 10 line. All right. So you and I may be cut from the same cloth. Not everybody is that way. So that's why I would say, shoot for about 50% of what you own. My stocks in a retirement account, so no capital gains issues. All right, let's see then. Well, if you have no capital gains issues, then you might really consider just doing the short calls. You get the short calls, it gets called away from you. You go out there, sell puts, get it put to you, and you just keep scalping the market that way. So if you aren't worried about capital gains or any of that, that's how I got into trading. I basically got into trading by selling short calls against Walmart and IBM. They'd get called away from me, and I'd go in and sell puts. I'd get put to this, or the stock would get put to me, and then I'd go and start selling covered calls against it. That's literally how I got into trading. I bought stock. Actually, I got into trading. I bought stock, and I watched IBM and Walmart basically trade in a range. It was like IBM would get over 100 and go back below 100. Walmart would go above 50 and go back below 50. And it was just like, after watching this for several months, I basically was just on the phone with my broker, and he was like, "Why don't you just do covered calls on these things?" He was like, "You get an extra dividend." I was like, "I love dividends. Who doesn't love dividends?" So that's literally how I got into it. I didn't do the call spreads or anything else. I just literally went in there and wasn't worried about any of that other stuff and just started playing the market that way. Okay, I'm confused. If you have equity, are you suggesting a short call at a higher strike and a long call at a higher strike than the short call? No, Bob, what I'm saying here is if you are worried about capital gains and you are, this is a higher risk tolerance and you aren't worried about any of it. I just did the short call, covered call strategy webinar last week. I would check that out. I'm not going to really waste everybody else. I don't want to, I could spend another hour on this, right? But, look at that one. And then coming up, I'm going to be doing the short puts to add, dollar cost average to your portfolio, which is another great strategy. In the meantime, you're collecting a dividend. If a broker is calling you up and saying, "Hey, I think you should buy XYZ, it's a good time." Well, I would be asking him, "Dude, why didn't you call me the last 3 months about selling puts?" I could have been, lowering my cost basis selling puts when it never got down there. But now that it's a correction, I could have been having the stock put to me at the same level that you're calling me up at now, which is a better strategy in my eyes than just, taking a dart and throwing it at the calendar and saying, "That's the day I'm buying." All right. Which is what this is all about. I don't mind talking about some of those other strategies in this webinar because, in a brief overview, because that's what this is all about. Ultimately, we put all of this stuff together, you guys, and that's how you really, in my eyes, or how I would trade a portfolio that I wanted to build out for, say, Bob's retirement, right? In the meantime, when you're in your early years, your early 20s, selling calls against underlyings, you have covered call strategies, and then that call gets called away from you. Well, what do? You just go in there and start selling puts. I want to buy it back. Well, you pick the level you want to buy it back at, and you continuously do that. It gets put to you every once in a while, maybe 10, 15% of the time, and you're dollar cost averaging. But in the meantime, you've gotten all of those credits. So, literally you can lower your cost basis on something to zero. It's synthetically, it's not going to show up in your P&L or when you're looking at your stock. It's still going to say, well, you bought it at this level and sold it at that level. But then you go over to the P&L and see what your prices of collections are and add all that up. And you can see that sometimes you will be able to get that to zero. All right. So let's just say, for instance, because we're getting a little bit behind. Some people with smaller portfolios, right? You don't have stocks in that portfolio, especially when you're starting out, right? A lot of people, especially with the new age of ETFs, is you would have an ETF to try and capture what the overall market is, right? You have all of those stocks in this ETF. Well, you know, you could use this against ETFs as well. So, like I said, you know, we could look at the February, right? And I could go out here and look at this 34 delta, and I can go, I probably try to go, I'm going to 35 delta. So I'd sell that one. Let's just say we're going to go for $1 wide. What I would try and do, $1 wide. Now I get 38 cents. That's better than that, you know, 30% with the strikes. That's kind of where I would look at. If you like to look at the charts and stuff like that, obviously I would go and look and see what my strike location is for that. I'm basically selling the 66 and a half. I want to make sure that that's kind of out of the realm, you know, it's pretty close, especially if you're bearish, you know, it'd be right in there. Are you comfortable with that? I would probably go and say, you know, I'm still, you know, short-term bearish. If I wanted to do it, maybe I'd come out here and say, all right, I'm going to look at the 35 delta here. And, you know, with this much premium, you could probably even go and say $5 wide. So let's just check out a $5 wide one and see if it works. So that would be the 73s. Kind of blind here. $1.46. That's close. You know, that's $5 wide. That's inside of that $1.25 to $1.60 that I'm looking for. So I might do something like that, right? And then if it blasts up above 173, then, you know, that's a new all-time high in IWM. Do you think that's going to happen? I don't know. I mean, how bullish are you, right? To me, you know, I think that those all-time highs have been set. They were printed during the day session, all of that stuff. So I think that the economy seems to be slowing. You know, all of these things that, you know, come into your thought process for trading are going to be applicable to this, right? So that would be my thought process. I'm not extremely bullish. I don't think that the market's going to fall out of bed, but I've got IWM in my portfolio, and if it trades sideways, like, you know, it has a tendency to do like this, I think it's going to trade sideways, then I'm very comfortable with that. We've had some major moves. Maybe it'll start settling down, right? That's where I'm going to look to start implementing this around my portfolio. Okay, so that would be another good example of, you know, going out to the March. One of the things I didn't do is, you know, IWM, I need to move my decimal 3 ticks to the left. Does it fit that rule being 16 cents wide to the bid ask? Yeah, you can see that it fits that rule, 16 cents to the bid ask. The duration closest to 35 days to expiration, right? The environment, I'm not too concerned about that, but I can check IWM and see where it is. Check it right here. It's probably, I would say, very close to 50%. You know, ETFs are usually going to be a little bit lower threshold, but if I have IWM in my portfolio, I'm not going to be too concerned about that. If I was looking at it for just a short trade, you know, my rule for ETFs is an IV percent of above 30, and you can see that that fits that rule. Are you doing that? Sorry, what was that? Oh, if you have a minute or two, can you do a trade with a short call deltas and see what the credit we get? Yeah, so I think I did. So, you know, I started out here with about that 34, 35 delta, 36 delta. You know, I'm also, like I said, with the duration, you know, I want to default the further away if at all possible. So, you know, I said you're starting out with that 36 delta. Well, I went right straight to the half standard deviation with this one and did it $5 wide. You don't always have to do just $1 wide. You can get a little bit more aggressive, especially the more bearish you are. You get a nicer credit on it, right? Especially on stocks that are above $100, you know, you're probably going to be looking at $5 wide. $100 stocks, you're probably going to be looking at about, you know, $1 to $2.50 wide if they have the half ticks on it, maybe $1 or $3 wide. And anything below like 75 or 60, especially below 50, you're going to be looking at $1 wide on that. All right. Another one that we could come up with an assumption on, let's say Goldman Sachs, right? Interest rates are really low. A lot of these banks are coming out and beating on earnings, and still, despite that, are coming off. I think more of that has to do with some sector rotation going on. But having said that, is that 250 plausible to be like printed in the next 50 days? Well, it has to do with your assumption. For me, I think a good one would be to short this. So I'm going to be looking at the 36 days to expiration. Well, I'm going to try and, 36 delta. I'm going to be trying to roll it out. I don't think that this is going to work, but I'm going to go try to do this and go $5 wide, right? And $1.23. You know what? I said my minimum is $1.25. Maybe you go up and throw it in there to make sure it meets the minimum and let the market work itself out. These are pretty wide for aftermarkets right now, 20 cents wide, 25 cent wide is my rule, right? Because you move the decimal 3 ticks to the left. Goldman Sachs is usually a lot tighter than that. But you can see it's pretty close to fitting that rule on 25 cents wide to the bid offer on the just out of the monies. And that's another thing I may have not mentioned. We're looking at the ones that are just out of the money to fit that rule on the ones that are closest to 35 days to expiration. Okay, so this one, I'm able to fit that rule on the minimum by rolling just a little bit out. So it's not always like a hard line, get as close to 36 delta, I mean, yeah, this one I'll probably get a better credit for, but to me, I don't know. I think I'd rather go a little further out. I'd rather go $5 higher and, collect 50 cents less. Why were you looking at the put side strikes? Only to fit this rule on, does it fit the right underlying? Moving 3 ticks to the left, making sure the bid offer is tight. All right. So you want to double check, the calls and the puts. It's not always just, that's just for that one rule. But yeah, you can check the puts too to make sure they're fitting it. Maybe these are, let's say these are 26 cents wide and these are 20 cents wide. There's a lot of eyeballs still in there. Okay. Cool. I might as well do the win. Let's just take a look at win, right? I have a feeling win's not going to do too great coming up. You can see this is all about the virus. Another thing is, so, the way I trade or however you trade, they've got high implied volatility. I don't think they have earnings. They may have earnings coming up. Now that I look at this. Maybe a case to sell a little bit closer duration if they don't have earnings inside of this month. Maybe it's coming in February. Cross-reference it with the other chart. Let's just take a look at when. No, it's right around the corner. I don't think they're, it's going to really be about their forward guidance call afterwards. And I think most of the news, is already out. So I don't know that I would sell a call spread against that at this point if you had already missed it. All right. I'll take a look at DAL because I just covered my short calls on this. I had on 63 calls that, if you guys watch the daily market commentaries, I have a synthetic long in DAL. I'm short Boeing though. So obviously this has not gone my direction, but I did cover the 63 calls because I was doing covered calls against it. You can see the synthetic longs in there. So let's take a look at this. Maybe I want to do a short call spread against this. I'm going to kind of look for that 36 delta. You can see that there isn't one. So let's see what it looks like for $1 wide. $1 wide, I can already tell you it's not going to fit. 76 cents. My minimum on a dollar wide, I said, was going to be what, 25% the width. So 25% the width would on a dollar wide. Oh, I went $5 wide. I'm like 25%. So $5 wide, I would need to collect about $1.25 for that, right? So in that case, I would probably have to go and say I would sell the 48 delta, which means I've got a 50% probability of being in the money at expiration. So it's 50-50 for $1.50. You know, that fits that rule. But do I want to be that close to where the underlying is? I mean, 25 cents, 30 cents. You can see it was 45 cents today. I would have to be really nervous in order to do that. And I'm not that nervous at this point. So I would probably hold off on something like that. You know, that's just not worth it for me to get that $1.50 credit. I'd rather risk it and have the, you know, risk the $1.50 move to the upside on something like that. So that's why I covered those calls. I was directionally right, get out for a profit and just see how it goes at this point. So you don't have to do it every single time. I might actually, if I was really in this and I'm not loving this trade at all, this would be a situation, Bob, where we were talking about earlier. I would probably rather default to selling the 16 delta short calls and collect 50 cents because I'm long this thing at $60. So if I collected that 39 cents and I'm long at 60 minus, you know, my collections, I've synthetically lowered my cost basis on this. I'm probably at 59 now. You know, then I get $3 to the upside and get to keep that credit. So I make it $3.40 some cents on a trade. I would do that. I'm not in trades for long duration. You know, if I have an underlying in my stock or if I have an underlying in my portfolio, I'm selling calls against it. I'm happy to get rid of it. You know, like with eBay, it's in my portfolio and I'm looking to do covered call strategies and everything else. All right. In the bell curve, can you clarify the rationale of the 36 delta for the short and the 16 delta for the long? Basically, it's about probabilities. You know, when it comes down to it, I want to be able to get a collection of about 25 to 30% the width of my spread. That to me is the risk reward. You know, I'm risking one, you know, I'm trying to make one and risking two in that sense. All right. So that collection, you know, is a nice collection for the risk, you know, especially when you're talking about a 36 delta. When we talk about delta, it tells us a lot of things. It doesn't only just tell you, you know, the definition of delta is delta is the effect on the premium for each dollar move in the underlying. Well, okay, that's all well and good. But delta also tells you all like 5, 6 different things, okay? And one of those is the probability of being in the money at expiration by 1 penny. So in the next 50 days, a 30 delta has a 30% probability of XYZ DAL trading $60.01 on March 20th. There's a 30% chance of that happening. Well, that's why I'm picking that 36 delta or 36-ish delta to start with, right? Because I'm looking at the probabilities. I've only got about, you know, a 1 in 3 chance of that happening, all right? So 2 out of 3 times it's not going to happen. So I can lower my cost basis continuously. Another reason why I like using just the short call, you know, 1.5 times out of 10, it's going to happen. But that also takes a higher risk tolerance for you, right? And on the bell curve is just a great visual representation of probabilities, right? I'm trying to find my bell curve. So if we go to the bell curve here, you know, the bell curve is just a great representation of probabilities. You know, it's back to when you were looking at your you know, it's in school kind of thing. You know, if the A's, the B's, and the C's are right here, you know, it's middle 50-50, the D's and the F's. All right. So the probability of, you know, this happening is about 34%. I lost my pen. So the probabilities of that happening is 34%. Now the probabilities of this happening is 66%. Right? And you can say that, you know, because I have a bearish assumption, or you see some, maybe it's up against the Fibonacci, you know, one could say that you're shifting the probability, you're turning the table a little bit more in your favor, right? You're turning the table in your favor when it's bouncing up a resistance area. It's at the point of control where the most time and volume's been spent, where everybody's comfortable, all of that stuff. Okay, so you just choose the $5 width. The reason why I chose the $5 width on that is because I was able to collect that somewhere between 25 and 30% the width of the strikes. Yes. I don't even usually look at the delta on the outside. You know, on my short calls, I'm looking at it around that 36 delta, and then I'm trying to pick the long call that allows me to collect the credit. All right. I can just tell you that if it's less than $100 stock, you're probably going to have to be if it's basically between a $50 and $100 stock, you're going to be looking at the dollar to the say $3 wide strikes. Anything over $100, you're going to be looking at about the $5 strike. Anything above, like say $300 underlying, you're probably going to be looking at $10 wide strikes. Okay. It'll still work with a $5, but you know, you can get a nice healthy credit on the $10 wide. Okay. And that way, you know, remember where your break even is you got that collection of credit also. So that collection of credit is above where your short call is. And the probability is, even if your short call goes into the money a little bit, you know, you still have the probability that it might come back out. Now, if you have the underlying in your portfolio, you don't want to get rid of it and it blasts through your call spread, then I would probably cover the call spread and be done with it. Right? If it's just toggling around my short call, I'll probably risk the stock getting called away from me because I know the probabilities are the probabilities. Probabilities of that happening are only 34%. If you're worried about capital gains and all of that stuff, cover the call spread, move on with your life, wait for another time to start lowering your cost basis again. All right. You have any other questions? Anybody? Bueller? No? Good question. Yes, I do look at the probabilities of touching. Absolutely. You know, that's some of the floor. That's another thing that Delta tells us is the probability of touch. And probability of being kissed is what we used to call it on the floor. Your probability of getting kissed is twice as likely as anything else. But your probability of being touched is 2 times the delta. And that's a great floor trader hack that we talk about, you know. So there's a couple other ones that we talk about in the floor trader hacks. It's not just about delta, but this is the deal, you guys. We're giving a huge discount because we're part of this, the Wealth 365 Summit. Hopefully you guys took advantage of that and jumped on that. That was a fantastic week long of educational webinars that I was a part of. So this was the course we kind of set up for that. It's right here in the URL. You got to punch that into your URL. If you're watching this live, that's not going to work for you over there. I don't think that hot link that I just put in there will work. But here, let me pull this up. So this is the actual link here for that. floor trader hacks, all of that stuff. I'm going to throw this link over in the chat window for you guys. I guess it's, hopefully that goes out as a link. Not seeming to like, oh, because I don't have it in the chat window. There we go. Let me put it in the chat window now. There it is. That works. So over in the chat window, I have a hot link. If you click on that, it should bring up that special offer into your web page like that. If you're watching on tape delay, you're going to have to pause it. But this is a great course. Some of those things, you know, probability of touch, those are things like, you know, the 34 delta we're using. Well, there's a 64% chance or 68% chance the market is going to come up. There's a 68% chance using the 34 delta, right, that the market's going to come up and hit my short call. But there's only a 34% chance of it staying, you know, a 34% chance of it being in the money at expiration. So the market will go up, maybe kiss it, and come back down again, right? And then maybe start rallying up. But there's only a 34% chance that it will finish in the money at expiration, but there's a 68% chance of the market going up there and touching. That, all of this, I always say the hacks will help you sleep at night, you guys. They are ways to streamline the process. Actually, this is just streamlining your process so you can think about things a little bit quicker. Floor trader hacks will streamline your process, knowing deltas, knowing, you know, intrinsic, extrinsic values, stuff like that. Volatility Crush will let you sleep at night. Understanding volatility is the most important thing in trading options, all right? I talked about volatility not being as important in this particular implementation of this strategy in your portfolio. But if you're doing it in high volatility, then you are going to get paid off much quicker if that volatility comes out. I talk about all of that. You'll learn to understand volatility like the back of your hand if you guys follow me. Like I said, I'm teaching you guys how to think for yourself. If you guys are looking for somebody to tell you you need to go out and do this called butterfly against XYZ at this location, that I'm not your guy. But if you want to be looking at watching TV or coming up with your own concepts or your own directional assumptions, then I am the guy for you because I teach you guys how to trade options. Right now, we're right in the middle of earnings season. This is a huge course. I talk about specifics in and around every strategy for earnings. Those are different than what we're talking about with the covered calls or the short covered calls spread. I'm going to have slightly different rules for all of that stuff. Learning how to trade options like I do. Portfolio protection if you're worried about your portfolio. If you want more income right now, you know, especially baby boomers are struggling to have, you know, a portfolio generate income, especially with the low interest rates. I even talk about, you know, Fibonacci, how to set up those Fibonacci and, you know, a special course on implied volatility there as well. So all of this stuff, you guys, you pay for this, you get to keep it. And as a matter of fact, we have these little boxes next to every webinar, all right? And basically, once you've watched it, it checks it off for you. Yeah, you've watched it, or you've watched it to here, you know. So all of those things are in there, so you can follow along. Yes, you can find some of my stuff, my content out there on YouTube and on our Facebook page. We do push some of that stuff out, but it's not going to be in a specific order, all right? They're just kind of randomly thrown out there. And if you want to really drill down on the earnings and stuff like that, you will find all of the content right there. And it's, you know, not even all of the content is online. So you can go through and this would take you into summer, you guys. I'm telling you, this is hundreds and hundreds of hours of, few hundred hours of content that you can take advantage of by just clicking on that over there. But like I said, you want to learn really how to trade. This is the course. You should take advantage of it. And this is the last week we're offering this because we're done with that whole Well 365. After this, it's a new month, and this is going to be gone and lost. So make sure you can kind of take advantage of that. What was the name of the week long summit you commented on? It was called Wealth 365 Summit. And there was 90 speakers basically from Monday to Saturday, all day long. All right. Like I said, click on that, especially if you learned anything at all. You know, I mean, I know other people can teach you guys how to do a short call spread, but I will tell you that those guys are not going to have rules. They're not going to give you strike location, how much you can collect on it. Investopedia is not going to give you a specific guideline on a collection of credit. You know, you might be doing a spread based on what they say, and it's going to give you 25 cents or something, or maybe 20 cents. Then that's not going to work out for you. Our recordings available. You know what? Reach out to us, Bob, at you might be able to get them through Pro Trader Strategy. I don't know how they're doing the recordings on that. So trading at Pro Trader Strategies, or you can call us at 310-598-6677. If guys, anybody has any questions, somebody just reached out to me not too long ago about duration and stuff like that. You guys reach out to me about an options question, I'm going to answer it. I know, and especially if maybe a trade's going against you, I can tell you what I would do in that particular situation. I can't tell you what I think you should do. Keep that in mind, because I'm not giving investment advice. I'm just giving you the way that I teach and my rules. But, you know, take advantage of that. All right. I just want to do one more slide here to thank you guys all. Thanks everybody for attending this, and later webinars I'll be drilling down on different option components when and where I find those appropriate. There's also that link to the webinar that you'll have to punch into your URL. I probably made it hard for a lot of people to see that. All right, so thanks for watching, and if you want to contact us, again, there's our phone number and our email if you want to do it old school, or kind of old new school. All right, really take advantage of this. Last time we're offering it. That's all I got for you guys. Other than, if you can't take that, take it easy.